Dear all, welcome back to PMS Insights. The key concerns impacting Indian markets, crude prices, rupee depreciation, and FI selling, which were affecting investor sentiment over the last couple of months, seem to have abated. Crude now hovers around $60, rupee is holding steady at around 70 against the dollar, and FIs are turning net buyers for the first time in the last 3 months. High frequency data shows that inflation is expected to remain soft, with the latest inflation print coming in at 3.3% for the month of October. Bank credit growth is becoming more broad-based as credit growth to services sector grew to 27% year-on-year, even as the non-food credit grew by 11%. Post the IL&FS default led liquidity shock to NBFCs, which had created a crisis of confidence in the money market, the situation appears to be normalizing. Most of the NBFCs have been able to roll over and repay their short-term paper, albeit at higher costs. Bank credit data shows that things have started easing, especially for strong promoter-backed NBFCs. Benign inflation outlook allowed RBI to keep interest rates unchanged in its recently concluded MPC meeting. Moving on to the second quarter FY19 results, our portfolio companies delivered an average PAT growth of 22%, with 36% portfolio companies registering above 30% PAT growth. 70% of the portfolio companies delivered results which were either higher or in line with expectation. NBFCs in our portfolio continue to deliver healthy PAT growth led by growth in AUM. Apart from these, some of the consumer-oriented stocks delivered positive results led by volume growth and softer commodity prices. IT stocks in our portfolio also delivered encouraging results. The second quarter also witnessed demand pickup in industrials reflected in improving order book. Capacity utilizations crossed the threshold limit of 80%, which also hints towards possible addition of new capacity. Coming to the portfolio performance, we are observing a steady pickup in the overall returns over the last 1 month, led by financials like IndusInd Bank, L&T Finance, Bajaj Finserv, and consumer discretionary names like Maruti Suzuki, Z Entertainment, Bata, and Nestle. While the macro backdrop is improving at the margin for India, overhang with respect to global trade wars and upcoming state and national elections on the domestic front could keep the markets volatile. In this environment, we continue to focus on bottom-up ideas backed by extensive fundamental research and stringent processes. 80% of the portfolio would be skewed towards sectors with strong operating dynamics like consumption, IT, private banks, and NBFCs. The demand drivers for these sectors have low linkage to government capex or government policies, hence should stay resilient in an environment of political uncertainty. Rising consumer aspirations, premiumization, shift from unorganized to organized sector are few of the themes that are being captured in our portfolios and could play out over the next 3 to 5 years. Thank you.